Hey guys, welcome back to the Capital Mindset Show. Today we have a subscriber request, and that's going to be ASOS. So for those of you who may not know, ASOS is a British retail company, and it's actually been requested by a couple of our subscribers, both on our website and on the YouTube channel. And there was some little bit of added difficulty, but not really difficult, but just a little bit of more work that had to be done to convert the numbers, because IFRS is the accounting standard used by ASOS, and in the United States the main use is GAAP, but that's not really too difficult. I'll actually go over to teach everyone some of the ways we can calculate free cash flow with IFRS. That's a little more difficult than GAAP, but it's not really too bad. So I guess we can start off by going over what ASOS is all about, and we can do that by going to their website here. So let's actually go right over here, and this is a presentation. So we're not going to go over all 71 pages, but we're going to try to decipher from this what the company wants to highlight to us. And you see up here they have a strategic report, governance report, and financial statements. I'll stick to the strategic report for this section of the video because the financial statements we'll discuss later. So right now we're looking at a company that is trying to make certain initiatives that they think that can better interact with their target audience. And what some of that is, for example, here we have investments in clean energy, stuff like that. So they're probably going to, shout that to the rooftops so that their customer base can appreciate them for what they're doing, and so that they can hopefully increase their sales and become or gain a higher sentiment among the target consumer. So I can see that they're investing a lot, by the way, in, for example, infrastructure and those fulfillment centers. So you want to make sure that they are making those adequate investments, and we'll actually talk about that later on when we get to the financials, because they're increasing their capex. And then some more. Well, we don't really need to care about that, but here it's something I want to show, the business model. So if you didn't know already, they have a variety of brands, and then their focus is to try to become the best in their little sector or niche. And they believe that the market is heavily fragmented. So they believe that they're able to capitalize on that fragmentation, and over time, according to them, that the market will begin to consolidate under a couple of houses. And what I mean houses is companies with a bunch of brands. So what they believe that they have as their competitive advantage is their brands, their platform, and their experience. So I personally don't buy from ASOS, but many of you may or may not be customers of ASOS, and please feel free to leave your comments down below what your experience is. But that's definitely most important, or something that should be considered, because that's what they're saying we should consider as an investor. So their ability to grow and adapt new brands is going to be very important to kind of keep up, because the problem with fashion industry is you're always having to keep track of what's the new best thing. And if you're not, you stand a risk of falling behind. So we want to see, for example, also that their adaptation to technology. So as you can see here, we want to see mobile device visits to go up, because people are on their cell phones, and if you want to adapt to where the customer is going, not the other way around. You can't expect the customer to adapt to you. And then you want to see these conversion rates go up. So that's when people basically visit and then they buy, right? Conversions have to go up, mobile device visits have to go up. You want to make sure you're converting those customers when they show up to the platform. They won't really convert me, trust me, but they may convert other people. So I'm not their target audience, I'll just say that. But this is a kind of a look at some of their different brands. If you guys want to pause the video here and read some of them, or go on their website to read further. But here they're just talking about their culture. We don't really care about that for the purpose of what we're talking about here. Okay, so they're basically showing that they're expanding. They hired 1,000 more people, performing more interviews. Like, that's good from that perspective, but it's not necessarily telling me about anything about efficiency. Okay, so you see here that core to their values is being basically an eco-friendly company, and focusing on some of that ESG themes that maybe our guys are familiar with. This continuing on the same thing, nothing really to want to talk here. Okay, so bottom up approach and then top down review. So bottom up approach is what they claim to be implementing in the business, and for some people that may be a good thing. So basically some of the benefits of bottom up review and top down review is the ability for, or the focus that each one can kind of be better at, right? So bottom up review allows, for example, associates to better give their voice as to how the operations are going. And then top down review is more of like the management or the upper management's review of how they're doing. So nothing too important there if you guys were paying attention to that. And this is basically like they're managing the risks. So it's nothing crazy there. We won't really go over that. Supply chain disruption, we want to make sure that they're mitigating that, but I won't go over that too much here. I think we should probably just skip over to the share price results, because you're probably asking why are we getting this request and why are people talking about it on YouTube? We're a little late to the game here at Capital Mindset, but we're going to talk about it now. So basically everyone's talking about it because it's down, right? We see a decline right here of about 50%, 57%. And over the long term, we see a very cyclical trending business, right? So you have your up and you're down, up and you're down, up and you're down. So each time it appears that each time the company has faced troubles, is it been able to climb back up? All right. Is that indicative of what will happen forever in the future? No. Be very careful. And we can see here that the price was 50% lower during the lows of the pandemic, right? So, or greater than 50% lower than the lows of pandemic. So be very cautious with that. Don't just assume because it's down, it will go back up. That's a little pet peeve of mine. So don't do that. And we see a market cap of about 2.4 billion British pounds. All right. So we're not dealing in dollars. And like I said before, it's a UK based company. Okay, so this is the part where we can talk about some accounting metrics or some accounting shenanigans that we're going to have to do to kind of normalize it. Unless you guys are used to IFRS, but I'm speaking to those of you who may not be used to IFRS and are used to more GAAP accounting. And so we'll actually go over that right here. So I actually have some of it highlighted, but basically in order to calculate the free cash flow that you want to really take into account, you're going to have to do something a little different. So normally you can do that by taking the cash flows from operating activities and subtracting out the capital expenditures. Now there's a problem because in IFRS, for better or for worse, sometimes it can provide more detail and sometimes it can be annoying. But it's supposed to ideally bring one accounting standard to the entire world. Now, there's some gives and takes, but this video is not about that. So the way you can calculate free cash flow in this case, you take the same number here and we can subtract it by 102 right over here. Then you have to subtract it by the payments to acquire property, plant, and equipment. So this is like your standardized CapEx, but you have to add this in. So both these numbers together are CapEx. And then from there, you're not done. All right, so ASOS, the numbers it's really small from here. So the difference, if you don't include this, won't be too drastic, but you need to include a lease. And ASOS is actually nice enough to include the lease charge here. So you have to actually subtract out this 23 right over here. So when you subtract out those numbers, so when you do 215 minus 102 minus 55 minus 23, then you get to the free cash flow number, and that's going to be about 35 million. ASOS is actually nice enough to provide that for you up here. Provide it somewhere. I'll find it in a sec. But not all of them will be so nice, but that's just for you guys to know going forward. If you guys look at another IFRS, how to calculate the free cash flow. Operating, so it's definitely above here. It's above here. It's above there. Ah, here it is. Okay, so yeah, free cash flow, like I said, it was about 35 million. So they calculated for you, but then from there, we have a couple problems. So we have free cash flow. Now what's the CapEx? So I'll spoil it. All right, but the company is guiding to increase CapEx to about $210 million. Now let's go back to where they were at here. So here, the real CapEx is about $157 million, give or take, just a little bit, that 0.1, but $157 million. So there's about a almost $60 million more in CapEx that we're going to see. So we can take that number and then we can adjust that here. And I think I already done that ahead of time. So right here, so we're basically going to get a very low, or actually negative CapEx, right? Sorry, not CapEx, cash flow. So the price is going to be reflective of that. So what we need to concern ourselves with is this number going to stay like that forever? So going back here, if we can show this, there's an increase, right, in inventories. So they're paying up for inventory. They're paying for a lot of new inventory, and maybe they're going to not do that in the future, maybe. So we want to maybe adjust for that, because if you see in the past year, they didn't. They actually sold more inventory, right? 4.4 million. So that's a positive, a decrease in inventory. And is this a permanent problem, or is this a temporary problem? So if you want to adjust for that, then we can, for example, let's make an assumption. Let's say it gets better by $100 million, right? So they cut that back by half, but they still have a negative 100 million. So from that assumption, and that's an assumption, so be very careful with that. Let's assume a 135, right? And so we're still going to have, for the most part, negative results when it comes to the investment, because we're still below our CapEx. We have negative free cash flow, and we're basically going to grow negative free cash flows going forward. So average growth rate of the past years has been 17%. So let's take our 17%, and then let's actually see, for example, we can use a free resource, and I'll use Seeking Alpha in this case. So let's take you, and then let's see, for example, let's see what Seeking Alpha says here. So, okay, they have the same thing. So we're not really getting anything extra from that. So we can say 17%, and let's make further adjustments. So let's say 20% on the high end, 17%. Let's make that a middle assumption. Let's say a low assumption of 10. And then let's say 15 and 18. Okay, on all accounts, we got to assume for a 15% discount rate, we have to assume a growth rate of 20%. So then let's kind of play around, and that, remember, that's under the current assumptions when we adjusted for the cash flow from operations for 135 million and the negative, or sorry, the CapEx of about 210 million. So let's make that adjustment. Let me see if it's pulling correctly, to be honest. Cash flow from operations, yep. CapEx, yep. So we should be good on that front. So basically, if we take a step back and we look at what we've basically been talking about, as far as we know right now, we would be taking in, assuming that we are right now, well, yeah, right now we are assuming that they improve it by about $100 million. If they're able to actually normalize this and actually improve upon it, that could change the model, what it's putting out. So let's say they can do about 200 million. Well, that will change the metrics drastically. But I think that CapEx over time is going to come down. I don't think it's going to stay at 210. I think it's going to be 210 for the foreseeable future. So we can think about how we can model that out. And the best way I think would be to do it is to kind of just think about averaging it out. So averaging it out of the long term, I think CapEx will return to a more stable realm. So we're going to be making some assumptions here, and we have to, because that's kind of like the only way we're going to get around this here. So if I assume they can just do a negative 100, and then we can assume, for example, about 200 million in long-term free cash flow. So we assume 200 million in long-term free cash flow and smooth that out. I'll show you how now the model kind of adjusts for all that. So now the model's spitting out different scenarios, right? All right, so now at a 15% discount rate, we can see that after we've smoothed it out, we have more buying opportunities under certain assumptions, okay? But again, I kind of smoothed out some of the performance metrics over time. I assume that they're not going to be spending $210 million every year. And then we decrease that number over time. So let's actually take a look at what would happen if we discounted it further. And we can see we're almost there for the 20% assumption. So if you wanted that extra margin of safety, it's not quite there yet. And I actually want to make sure that they are buying back their shares. So they're actually diluting you. So I'm not even assuming a share dilution. So that's kind of concerning to me as an investment. I know that this is a popular investment right now, but it may not be just at the right price for me to consider it adding to my portfolio as of yet. Let's take a look at some of the key ratios, and I'm going to take a look at inventory ratios because I think for this business, it's obviously important. So the current ratio, okay, so it's getting better. We like that. Cash ratio. Okay, so solvency ratios are decent. They've taken on some debt recently, but nothing that's not manageable whatsoever. Gross profit margin is, declining a little bit, but I saw that their long-term goal is about 50%. So if they can achieve 50%, great. So let's assume that their goal is to get there at some point. Return on equity is actually pretty good. It's declined, but it's still pretty good. 12% is respectable. Return on assets, don't expect much from that metric for this kind of company. All right, shifting over to the earnings quality. Earnings quality is phenomenal across the board, so it makes me more comfortable with my assumptions that I made on the cash flow statement. Book value per share, that's actually quite high for this kind of business. I'm actually intrigued by that. That'd be a point of further research to make sure that book value is what it is. It's not really something I'd lean on for a company like this, but it's good to know that the book value is not too far off from the share price. Okay, so inventory ratios, or sorry, activity ratios. We want to pay a little more attention to this. So we see inventory turnover getting worse, not a good sign. Days of sales outstanding, or days of sales inventory, not a good sign, getting worse, but a great 2019 and 2020 relative to historical. Accounts receivable turnover getting worse. That's about the same. I'll count that as the same. And then this is getting worse. So not too intriguing when it comes to the activity ratios, but that's not a deal breaker necessarily. It could just be short-term spats, here and there, but I'd be keeping an eye on that. Now this company's not going to go bankrupt anytime soon. I think the model's telling me that we're fine on that front. Yeah, we're fine on that front. So, and I mean, it makes sense. So it coincides. It already passed the smell test on that when we look through the solvency ratios, and then the liquidity ratios look pretty good too. So I'm not going to say by any stretch of the imagination this company's at risk of bankruptcy. I don't think so at all. Now the problem is I'm in the model right now. I'm not assuming any share dilution. I'm just assuming neutrality, and what we can see is they don't have a history of doing that. They've actually been quite dilutive over time, and that can destroy your gains. So like, for example, if I say they're going to repeat that, it'd be foolish in my opinion to do so at this moment, but Who knows? And then you can see how that's affected everything. So now in the highest assumption, I have to get in at about 20 bucks while this price is currently at 34.78. So not too exciting from that perspective. Now, if we want to lower our assumptions, right, and say, I think Sven Carlin, he only discounted it to about 10%. And he uses he's a favorite fan of the terminal multiple approach. This is using more or less the perpetual approach. But this model actually uses both, but I'm not showing one of them. So the discounted cash flow analysis, if we discount it at 10%, it's a buy across the board, even assuming a share dilution of 4%. So if you compound that out long enough, you could generate nice returns, but the key word is long enough. But if you're looking for, you're expecting a greater sum of return, let's see if we discount at 12%, you have to then start to assume 17 or 16% growth rate. So let's actually change that to a 16. Okay, so yeah, around 16%. And we can still assume that negative 4% share dilution. I should be assuming almost 5%, but I'm assuming 4%. And then they are capable of doing some buybacks, but they're just not doing it right now or have been doing it. So I'm not going to assume it into the model. If you think I should, I can do a follow-up video and change some assumptions around. But for the most part, this is interesting company in the sense of what it does and why so many people are maybe interested. But for me, it's I can't really make an accurate prediction as to the performance of the business because it's not my forte. I'm not really a good at predicting retail trends. So I'll acknowledge when my weaknesses show, and this is one of them. And also, I don't really know anyone who's a customer of this business, but maybe you do, and then you can really, decipher what the growth rate is. So for me personally, this company is kind of a pass at the moment, even despite that other investors who I may consider to be good investors are invested in it. Again, because I think that's argument from authority. I've stated that in previous videos before. You never should just follow someone blindly that's investing in something, despite of however much credibility you might assign to them. Because that in and of itself is argument from authority, and that's a logical fallacy. So you shouldn't really be doing that. But if you guys have any questions about this very brief analysis or IFRS and the conversions to kind of gap measurements, let me know, and I can try to answer them in a reasonable amount of time. We have more videos coming out for international companies because we actually got a decent amount of requests for international companies, more than I ever thought we would. So if you guys have made the request and you guys know who you are, don't worry, we're working on it. We just have to make these conversions, and sometimes the different ways we can port in the numbers, we have to do the adjustments kind of manually. And then on top of that, we do the research on the company and see what they're trying to do. Sometimes, for example, in ASOS's case, it's retail, so I can't really provide too much color in terms of their success rate. I can say that, for example, for what it seems, they have been growing sales tremendously. So 17.3% is nothing to sneeze at. And if they were to continue that for 10 years, that'd be very, very good growth. Now, you've seen in the model today the assumptions that we made, and then what it's kind of returning to us and when we should be adding, depending on the assumptions that we're making. But I mean, I'm being pretty fair. I'm giving it a negative 4% dilution rate, 12% discount rate, and it's saying buy if you believe 17% growth in the cash flows. If I lower this to, let's say, negative 2%, now the story changes. But let's say we can discount at 15. All right, we can discount at 15 only if we grow at 20%. So you've heard it here, folks. This is another subscriber request. If you guys have another request, please feel free to leave it in the comments. We can add it to the list, or go to our website and you can submit your request there. Thanks, guys. Have a good one.